Hello, this is Bob Steele. In this video, we will be talking about itemized deductions. At the end of this lecture, we will be able to list itemized deduction categories, describe the deductibility of medical expenses, describe what taxes are deductible, what types of taxes will be deductible, that is, describe what interest expenses can be deductible, so what types of interest can we deduct, explain what charitable gifts can be deductible, so what kind of charity items will be deductible, define casualty losses which can be deductible, and list items that are categorized as miscellaneous expenses, so miscellaneous items that also can be deductible in the itemized deduction category. So first we'll start out with the tax equation once again, and we're working our way down. So we have seen the line item of gross income. Remember, we're talking about the income statement when we're talking about taxes for the most part, and the income statement includes income and expenses. The expense side of the tax equation, of course, we're going to call deductions. So remember that it's flipped on its head. Income for taxes is bad, whereas income for accounting purposes is generally good. Bad in that for taxes, in that it'll allow us probably to have to pay more taxes. So we want the income that we need to report to be lower, the legal income that we have to report to be as low as possible. We want the legal deductions that we can deduct to be as high as possible. We talked about the above the line deductions in a prior section, and those are the lines that are deductions for adjusted gross income. That will lead us to the adjusted gross income, otherwise known as the AGI. Now we're going to deduct the items that probably are more common to most people, the types of deductions that we've heard most of the time, like charitable deduction, home mortgage interest, and whatnot. Those are going to be deducted in the itemized area. What many people do not quite understand on the itemized deductions are that the itemized deductions have to be greater than the standard deduction in order for them to give us any type of tax benefit. That means that basically we're given like a standard deduction level line that everybody will then get, and then you're going to have anything above that, we would have to then count the itemized deductions, and if they're greater than the standard, then we would then take the itemized deduction. I'm going to try to give some explanations as I do for some of the items that we deduct and income that are included as we go through. And notice I've had many tax instructors, I just want to point this out, that have basically said that if you're looking for reason in the tax code, you're looking in the wrong place for reason, basically. And from a tax preparer perspective, notice that there's truth to that. In a preparer's perspective, it's just basically, what is the tax code and what do I need to report in order to come up to the correct tax amount? How much can I deduct legally? Obviously, remember that the tax is a law, however, and from that perspective, we're all voting on the law. If we're going to discuss the law, if we're going to discuss taxes with other people, people are probably more interested in the relevance of the taxes. Why is the tax there? Probably makes the deduction more interesting to most people as well. So, looking for reason in the tax code, although maybe a fruitless act, is somewhat interesting and can be applicable in a lot of areas as well. So, the idea of having a standard deduction possibly would be something like, we want to make sure that everybody gets a set amount of deductions, whether or not they basically count them up or not. And if the deductions are less than a certain amount, we're just basically, the tax code is saying that don't bother counting them up. You don't have to take the time to kind of put this together and report all of this information. We're just going to give this flat rate deduction for those individuals that are under this threshold. If, however, your itemized deductions are above that threshold, then you need to add those up and compare them to that threshold, and then we'll take the greater of the two. These are deductions, meaning that we want more of them, so we're going to take the higher of these two amounts. Alright, so remember, as we go through this entire lecture, we are right here. We're talking about itemized deductions. The itemized deductions must be greater than the standard deduction in order to give us any benefit. One more thing to point out before we move forward is that the main thing that puts us over, the main thing that jumps most people into this section as opposed to the standard deduction is often the home mortgage interest. That's why that's such a big topic a lot of the time, the discussion on the home mortgage interest, because It's usually the thing that will be large enough to make it so the itemized deduction may be greater than the standard deduction. It gives a great advantage to people that own homes, and there's a question as to why that might be, but it's been there for a long time, so we'll talk about that a little bit as we go. So that's usually the one. If someone owns a home, they may well be in a place where they would itemize, and if they don't, they may well be in a place where they would not. So itemized deduction categories include, so this is just going to list the categories of itemized deductions. Then we'll go through each category and talk about the items that are within these categories as we go. So we have medical and dental expenses is the first category. Taxes you paid, and these categories will be on the Schedule A. So the itemized deduction is going to be on Schedule A, and these are going to be the categories of Schedule A. Then we'll go deeper into each of these categories and discuss further what they entail. We have interest you paid, so that's going to be a category on the Schedule A of deductions for itemized deductions, gifts and charity. Then we have casualty and theft losses is an itemized deduction category, and job expenses and certain miscellaneous deductions. So the job expenses and other like kind of random miscellaneous items, and other miscellaneous deductions. Okay, so we'll start off going down this list. We're going to start off with medical expenses. At the top of the Schedule A, you will see the category of medical expenses. These are the itemized deductions related to them. So the portion that exceeds 10% of the AGI is deductible. So first important thing to point out is that that's a huge cap on medical expenses, or that's a huge threshold that has to be overcome before medical expenses are deductible. So one, not only do you have to basically exceed the itemized deduction threshold, but two, you have to have greater than 10% of your AGI. And remember, that was that number we came up to before, which is the gross income minus the above the line deductions. That gives you your adjusted gross income, your AGI. And if your AGI was like $60,000, then you'd have to have medical expenses greater than like $6,000 before they even start helping you. So for that reason, many times, many individuals will not be able to deduct medical expenses even though they have a significant amount of them, because of this 10% limitation, as well as the fact that they may or may not be itemizing at all. The medical expenses must be for the taxpayer or the dependents, so someone basically within the household, someone basically that we are claiming on the tax return as someone that lives in the house or someone that is a dependent to the taxpayer. The medical expenses for those individuals would be the ones that could qualify for medical expenses on the taxpayer's tax return. So deductible expenses could include, obviously, the doctor prescriptions. So any doctor's prescriptions, appointments, and that whatnot would be deductible if they were not recapped with insurance. And the interesting one here is these capital expenditures that exceed the increase in the fair market value of the property. There's been a lot of cases on this which are somewhat interesting. So if the doctor came and said, you know, you have back problems, and I think that a thing that would help you would be a nice jacuzzi and a sauna within your home. And obviously, if you put that could be quite an expensive process to put those items in your home. The question is, could you deduct that in your home? And those are types of questions that basically come up. What if you put an elevator in the home or something like that because of mobility purposes? And the tax code basically says, well, if you spent $20,000 on this item that you put in the home, how much did it increase the value of the house by? If it increased the value of the house by $20,000, you don't get a deduction. But if it only increased the value of the house by $10,000, we're going to assume the difference, the other 10, is for medical purposes and therefore would be deductible. Transportation costs for medical purposes. So obviously, if we're going to and from different doctors and whatnot, that'd be deductible. Premiums for long-term care insurance as well. Okay, moving on to state and local taxes. So state and local taxes includes personal property taxes. So once again, if you own a home, the largest probably deduction related to owning a home would be the interest on the home. But second to that, you'd probably be paying local taxes, which would be real estate taxes, which could also be deductible. So state and local taxes are deductible for federal income tax purposes. This could be a little confusing, and it's another area that it could be that the tax code, the federal tax code, might be wishing that they did not include state and local taxes as a deductible item on the federal tax code, because it does create some confusion. So the idea being that we're talking about the federal tax to the federal government, And it allows you to deduct certain state taxes that we paid, basically on a cash basis method, including, in this case, real estate taxes and taxes paid for personal use of the car, auto. So DMV, portions of the DMV tax that we pay could then be deductible as an itemized deduction, only if we're itemizing rather than standardizing. Remember, that's always a qualification. So then we have state income tax or state sales tax. So this is really where it got confusing, because if we're allowed to deduct the state taxes, now we're talking about the entire state has to pay for certain items of the state to run, theoretically, to run the state. And those taxes are obviously collected from the citizens of the state. So those taxes are basically deducted on the federal income tax. Now, the thing that's confusing about that is that some states mirror the federal taxation format, in that, like California, for example, mirrors the federal tax in that we have an income tax. And so I live in California, we have an income tax. There's not many taxes that California does not have. And so, of course, income tax is one of them. So we have the income tax, and we pay income, and that tax that we pay to the state of California is then deductible for the Fed. But notice that other states are sovereign to do whatever they want in forms of taxation. So many states may not have an income tax, such as Nevada doesn't have an income tax, and many states may then still have to pay for what they need, but they may pay for it in another way. Another common form of taxation is the sales tax. So at some point in time, the idea came up that, well, it's not very fair to allow states who have an income tax to deduct taxes and not allow states who pay their taxes in a different format, such as sales tax, to not get a deduction. Therefore, there's a sales tax included as well, and it's usually either or of those two, because those are the two main methods in which states would decide to generate money. Again, take money that was earned by the citizens in order for the communal good of spending it on something. And so those are going to be somewhat trying to be equally deductible for federal tax purposes. And then we have foreign taxes. So option of a deduction or credit. Credit is usually better for individual taxpayers. So if we have foreign countries, we usually have a trade agreement or a tax agreement with many foreign countries that would allow us to work out the tax situation. So if we're required to pay taxes to a foreign country, then we can either take a deduction for the taxes we paid, or we can take a credit. Now, obviously, we want to take the larger of the two, the bigger benefit, the one that saves us the most tax dollars. Usually that's going to be the credit. We haven't talked much about credits yet, but credits are not deductions. They're at the end of the tax code. They're basically a dollar-to-dollar refund. So a credit basically means that if we paid $100 in taxes to a foreign country, we would get a dollar-for-dollar reduction in our tax of $100. Whereas if we were just to deduct that $100, then it would just be a reduction of our income, and we'd only get a percentage of that deduction when we apply the tax rates to it. So usually in an individual case, the credit would then be better than the deduction for foreign taxes paid. Interest. So we have the mortgage interest. It's going to be the largest, most, probably the largest deduction for many individual taxpayers. It's going to be the mortgage interest, and it causes a lot of differences in terms of tax planning as well. And notice that mortgage interest is basically for a personal residence. So we bought something like a personal residence, and we pay interest on it. And it's thought that that's kind of unusual in that we get that deduction in some ways, because it is a deduction related to a personal item. So there is debate at this point in time as to why the mortgage interest is basically deductible. Is it there to, prop up the mortgage industry, or why did that get there? Did it lead to, inflated mortgage pricing and whatnot? At this point in time, many people have basically, of course, dependent on the mortgage interest deduction. So it seems unlikely that it would go away, but any law could change as well. So the mortgage interest is going to be the main one that many taxpayers have planned on in order to budget their financing so that they can take that deduction, and that will be a large deduction. It also influences a lot of financial planning, in that if we had something like a credit card debt or a debt on a car or a refrigerator or something, we had a loan out there, many tax planners would then say, why don't you take, if you have equity in the home, convert that debt to the home, and then you can basically take a deduction from it. So if we bought a new car, the car would be collateral on the loan. And the idea is, well, why don't you make the home the collateral on the loan rather than the car? And in so doing, you could deduct the mortgage interest. So that's going to be a common financial planning aspect that really homeowners kind of, if they have equity in the home, have options to that. Again, renters don't. So that's kind of a situation there. So the mortgage interest is going to be probably one of the larger interests in there. Also want to point out the history of it a little bit on why the mortgage interest is there. One is, it used to be that a lot of interest, like even credit card interest, was deductible and other types of interest were deductible. And then they basically trimmed that back. So that could be part of the reason that the mortgage interest stayed there, because it was a significant deduction. It had been implemented in implementing all interest being deductible. And as people became more indebtedness in the U.S. on average, then the deduction for all other interests became undeductible, and the mortgage interest kind of remained there as a deductible piece. So points are amounts paid by a borrower in order to obtain a mortgage. So points on a home mortgage is usually deductible at the point of the purchase. If there were points on some other mortgage for a rental property, then we usually amortize the points over a certain time period. Investment interest, any interest paid to indebtedness property properly allocated to property held for investment, limited to the net investment income for the year. This one to some people seems kind of unusual because it's interest oftentimes on like passive investments, and people would think of that as kind of, again, a tax advantage to people that have money to make those investments, which are usually more well-off individuals. It does make sense in some ways in that this is just the normal kind of expense item. So remember that a normal expense in accounting would be anything that we had to expend in order to help us generate revenue in the same time period. So if we had the goal of generating revenue, even if it's passive revenue, meaning we're not actively involved, meaning oftentimes stocks and bonds are considered passive revenue because we're not actively working, we're kind of, our money's working for ourselves. But the idea being that if we put the money into it and we had to take a loan in order to do it, the expense on that loan is a normal expense. That's the expense that we had to expend in order to help us generate the money. So that's kind of like a normal expense idea of the reason why that would be deductible. They did put a limitation on this deduction in that they're saying that it's limited to the income. So you can't have investment interest deduction greater than the net investment income for the year. So that's not your total income, just the net investment income for the year. Okay, then we have gifts and charity, which is probably one that's very known for many people. And remember, many people may not really realize that the gifts and charity is an itemized deduction for federal income tax purposes. So if you're not itemizing, you're not going to get a benefit from the gifts and charity. Again, I recommend giving to gifts and charity for the benefit of giving to gifts and charity, and not just because there's a tax deduction, because there's other reasons to do that. But notice that for tax purposes, that you're not going to get the deduction unless you itemize. And again, so the main thing that puts people over is probably the mortgage interest before the gifts and charity will give us an added benefit. So in order for the gifts and charities to be deductible, the donations must be made to a qualified charity. So there has to be a qualified, basically, nonprofit organization. A specific nonprofit that does not qualify are political organizations. So if a certain political party or a individual is asking for donations, even if it's a nonprofit, generally not deductible. And the idea behind that is that when we make contributions to political organizations, it may very well be that we're trying to influence the political process and not giving money out of the kindness of our hearts, especially if we have a lot of money, and of course the government doesn't want to basically have large funds of money influence the political process and get a deduction for it. They want to incentivize the act, because obviously that may not be a charitable act. That may be an act to try to insert policies that would be beneficial to individuals. So clearly, if that's the goal, that's what the government's trying not to incentivize. So that's why that certain area is there. Obviously, if we give money to just individuals in need, if we go out and just decide someone's in need and we give them money, again, kind thing to do, but not deductible, because it's not a qualified charity to do that. So non-cash donations are deductible at the fair market value. So if we donated something like a car, or if we donated clothes or something like that, then we would have to deduct them at the fair market value, not the value that we bought them at. And you might be asking, well, how do I determine fair market value? And that is difficult. So we got to determine, I mean, if it's a large item, then we can kind of appraise it some way. If it's clothes or something like that, then we basically have to estimate that value in some way. And we can use some kind of discounting method in order to do so. Casualty and theft losses. So, and remember, once again, we're talking about the itemized deductions. So we're talking about casualty and theft losses in relation to itemized deductions on the Schedule A of the individual income tax return. So casualty and theft losses is defined as an identifiable event of a sudden, unexpected, unusual nature. So notice the key words here being sudden. It's got to occur at a sudden point in time. It can't be going over a long period of time, meaning we slowly lost, this thing over a long period of time, which accumulated to a lot of money. It's got to be unexpected. So it's got to be something that we didn't see coming, such as getting robbed or something like that, or an unusual nature. So it's got to be, again, something that is not usual if in nature. It's not something that we should assume is going to happen. It's something that we had not planned for. So this is a deduction related to a sudden, unexpected loss, and the idea being that we had no recourse to it, because there's no way we could have known that this sudden, unexpected, or unusual thing would then happen. Therefore, we deserve compensation for that. So the uninsured loss is the loss less insurance recovery. So if we lost like a, expensive video recorder or something like that, and it was insured, and the recorder cost, $5,000, and the insurance gave us $1,000, then only the uninsured portion, the $4,000, would be the part that we can be deducted. So if it was recovered in insurance, then of course, then we can't deduct it. We got reimbursed for it, so we can't get reimbursed and take a deduction for it. Each loss is reduced by $100, and the loss must be in excess of 10% of AGI. So this is another one that in practice doesn't happen all the time. People ask about it all the time. Hey, I lost this. Can I deduct it? And most of the time the answer is going to be, well, you're probably not going to get much out of it. Why? Because there's this huge limitation again, which is 10% of AGI. So what that means is that, remember, AGI is the gross income minus those above the line deductions. And so that's basically your income. So if your income is high, then you have to exceed 10% of it. So if your income was $50,000, the loss has to be greater than $5,000 before it starts to benefit you. Plus, there's this $100 kind of limit that you have to include. And this $100 limit is something that's kind of a remnant of the tax code, and you'll see this a lot in the tax code, where they put a dollar limitation for some reason or another. And due to inflation, this $100 is pretty kind of low now. It doesn't really do anything, but it's still kind of there. But when they first implemented that $100, of course, the $100 was worth a lot more, and it had a lot bigger effect on the tax calculation. It's just kind of there. And so obviously this 10% is really the big limitation, and we have this other $100 thing that we got to deal with because it's been in the tax code for quite some time. So we have miscellaneous itemized deductions. So this is kind of like the other stuff, and these must exceed 2% of the AGI. So we have a limitation. Once again, it's got to be over 2% of AGI, but that limitation is much smaller. So now these have to, it'll start to benefit us when it is over and the 2% of the AGI. And what we mean by this is all the miscellaneous stuff. So everything that's in this category must be over 2% of the AGI. So the main thing in this category is unreimbursed business expenses. So if we worked for a business where we had a lot of unreimbursed business expenses, for example, if we were a salesperson and we did a lot of driving and our company didn't reimburse us for the driving that we did on behalf of the employer, because if we were Schedule C income, we'd get to deduct that. But because we work on a W-2 income, it's kind of not fair in that case. It should be that the employer should reimburse us in some way. The best thing to do would be to go to the employer and say, hey, this would work out best for both of us if we somehow worked in the reimbursement, because the employer might get a deduction in some way. But if the employer does not give the employee the resources in order to do the job that they've hired the employee to do, then the employee can take the deduction here. And once again, it's not as good to do that because many employees may not be able to itemize. And even if they can itemize, they have this 2% limitation. So these items are deductible, but it's often good if you can negotiate with the employer to have them as part of your compensation plan, because then they could possibly be non-taxable to ourselves as the taxpayer, as well as a deduction to the person paying it. So it could be a kind of a win-win on both sides if there's a significant amount of unreimbursed expenses. So then other items that are usually smaller in this category, investment expenses, including investment advice. So this is one that kind of is overlooked a lot of times. Remember that anything that we do in order to help us generate revenue is expensable. That's kind of the normal rule of accounting. And investment advice kind of falls into that category. So if we go to a broker and they give us advice on our portfolio, we are getting advice in order to help us generate revenue. What kind of revenue? Interest and dividends. Therefore, that should be deductible, and it is deductible down here on the miscellaneous expenses. Again, we don't get as much of a deduction as we should in that case because it's limited to 2%, and if we don't itemize, we don't get anything, but it's down there. And then we have the tax preparation fee. So of course, the tax preparer gets their own little kind of line item there, so we get to deduct the fee for the tax preparation. So the common advice for the tax preparer, as a joke, but the common advice would be that if the individual is paying too much taxes, you can always tell them, well, you know, the tax preparation fee is a deduction. We can always increase that fee, which would lower the taxes, and so that would be good. And then we have the safe deposit box. So that would be another one that in order to protect our assets, that would be deductible. Usually not a big deduction, but it's on there. All right, and so now that's the major essence of the itemized deductions. And so now we are now able to list itemized deduction categories, describe the deductibility of medical expenses, describe what taxes are deductible, describe what interest expenses can be deductible, explain what charitable gifts can be deductible, define casualty losses which can be deductible, list items that are categorized as miscellaneous expenses. Thank you.